Insurance, right now, is something you've probably never thought about once. You pay a little money, something terrible happens, and suddenly there's a system that is supposed to help you recover. But a few centuries ago, none of that existed in anything like the form we know today. And houses still burned. Ships still sank. Harvests still failed. People still lost almost everything overnight. So what happened when disaster struck? Here's how people dealt with it before insurance. Imagine waking up in London in the middle of the night in 1666. You smell smoke. Then you hear shouting outside. A wooden house nearby is burning, and the fire is spreading from building to building. There are no modern fire engines waiting around the corner. No homeowner's insurance policy. No company you can call the next morning and say, "The house is gone." What do we do? And this wasn't just a problem for people who owned expensive houses. A disaster could wipe out the savings of an ordinary family in a few hours. If your house burned, you didn't just lose four walls. You lost your bed, your clothes, your cooking pots, your tools, your food, maybe your shop. Maybe the building itself was how you earned your living. And if a merchant lost a ship at sea, the situation could be even worse. A single storm could send an entire cargo to the bottom of the ocean. And the people involved might be hundreds of miles away, with absolutely no way to recover it. Today, we tend to think of disasters as something you prepare for financially. But for most of history, there wasn't a neat financial safety net waiting underneath you. If something catastrophic happened, you had to improvise. So what did people actually do? And more importantly, how did we get from "hope your neighbors can help" to an industry worth trillions of dollars? The simplest solution was also the oldest. You relied on your family, your neighbors, your religious community, or your professional group. If someone's house burned, other people could bring food. They could offer a place to sleep. They could help rebuild a wall or replace tools. And this could become surprisingly organized. Guilds and mutual aid groups collected money from members and used the common fund when somebody got sick, died, or fell into serious trouble. Basically, everyone put something into the pot because they knew that one day they might be the person who needed it. It's not insurance yet. But the basic idea is already there. Everyone shares a little risk so one person doesn't have to carry all of it alone. The problem was obvious though. What happens when the disaster hits everybody? If one person's house burns, the neighbors might help. But if an entire neighborhood burns? Now the people you're depending on have lost their houses too. So people needed another trick. This gets more interesting when we move into the world of merchants and ships. Imagine you're a merchant sending a valuable cargo across the Mediterranean. You have a ship. You have expensive goods on it. And you know perfectly well that storms, pirates, and shipwrecks exist. So instead of simply hoping everything goes well, merchants developed financial arrangements where someone else could take on some of that danger. One example was a maritime loan known as bottomry. The basic idea was that money could be advanced for a voyage, with repayment tied to the voyage succeeding. If the ship didn't make it, the financial consequences could fall differently than they would with an ordinary loan. It wasn't modern insurance. But the thinking was changing. You weren't just asking, "How do I survive if disaster happens?" You were asking, "Can I move some of that risk onto somebody else?" And that is a huge conceptual step. But there was still a problem. One unlucky voyage could still be financially enormous. So someone had to figure out how to spread the danger much further. This is where the idea starts looking much more familiar. Imagine 1,000 merchants. They each pay a relatively small amount into a common system. Most of them will never lose a ship this year. A few will. Instead of one unlucky merchant being destroyed financially, the losses are spread across the entire group. That's the basic logic of risk pooling. And once you think about it, it's kind of brilliant. You don't need to know exactly who will have the disaster. You just need enough people participating that the losses become predictable across the group. This became especially important in marine insurance. By the late 17th century, London's merchants were gathering in coffee houses to exchange information about ships, cargoes, destinations, storms, and other dangers. One of the most famous was Edward Lloyd's coffee house. And here's the weird part. The valuable thing being traded there wasn't just money. It was information. If you knew which ships were late, which routes were dangerous, which captains were reliable, and which cargoes were especially risky, you could make a better guess about who should pay more. Insurance was becoming less like charity and more like a calculation. But there was still one enormous problem. What about the thing that could destroy almost everybody's property at once? Fire. Then London caught fire. In September 1666, the Great Fire of London destroyed roughly 13,200 houses and left around 80,000 people homeless. And this disaster exposed the problem in the most brutal way possible. People could rebuild. But rebuilding an entire city is expensive. So after the fire, something new started developing. In 1667, Nicholas Barbon established an early fire insurance scheme. Later, in 1680, it became the Fire Office. The basic deal was revolutionary in its simplicity. You paid money before anything went wrong. If your building later burned, the insurance system could help cover the loss. That changes everything. You no longer needed to have enough cash sitting around to rebuild your entire house after a disaster. You could prepare for the possibility in advance. But here's the part that actually surprised me. Early fire insurance companies didn't just wait around for buildings to burn. They sometimes employed their own firefighters. Barbon's Fire Office used watermen as firefighters. And insured buildings could be identified with distinctive metal fire marks attached to the outside. Think about how strange that is. An insurance company wasn't merely saying, "Fine. Your house burned down. Here's your money." It had a financial reason to prevent the fire in the first place. Because every fire it successfully stopped was a claim it didn't have to pay. And suddenly, insurance wasn't just about recovering from disaster. It was about managing the risk before the disaster happened. This is really the moment the whole system clicks into place. People had been sharing risk for centuries. Families did it. Communities did it. Merchants did it. But commercial insurance turned that instinct into a specialized system. You paid a predictable amount now. A company or group took on an unpredictable loss later. And because thousands of people could be pooled together, the occasional disaster became financially manageable. The Great Fire didn't invent insurance. Marine risk-sharing and marine insurance existed before it. But the late 17th century was when these ideas began turning into something much closer to the modern insurance industry, including commercial fire insurance. And here's the part that actually surprised me. Some of the earliest fire insurers were basically combining insurance with firefighting. They weren't just selling protection after the fact. They had a reason to stop your house from burning down at all. That's a very modern way of thinking about risk. And once people figured out that risk could be measured, priced, pooled, and even prevented, the possibilities exploded. Fire, ships, buildings, life. Eventually, almost anything with a measurable financial risk could become something you could insure. So now go back to that little insurance policy you probably ignore. It's easy to think of it as paperwork. A monthly payment. A box you tick when you're buying a house or a car. But underneath it is a very old idea. People have always been vulnerable to things they can't control. The difference is that, for most of history, there wasn't a company waiting to absorb the financial shock. You had your family, your neighbors, your guild, your savings, and sometimes, basically, nothing. Then people slowly figured out something incredibly useful. You don't have to know when disaster will happen. You just have to share the risk before it does. And that may be one of the strangest things about modern life. We pay money every month for something we're hoping we'll never need. And when it works, that's exactly the point. So here's the question. If you lived in London in 1666 and had one choice, keep your savings in cash, rely on your neighbors, or pay for early fire insurance, which would you choose?